Welcome, everybody. My name is Marc Jimenez, at Wealth Advisor and Chief Investment Officer for CAM Investor Solutions. And we have a special guest today with Mike Olson of WealthPoint in Scottsdale, Arizona, joining us today. He's a partner with the firm. The firm focuses a lot on advanced planning topics and insurance strategies for various types of clients. And they also have not just clients in Scottsdale, but other offices around the country. So I thought he'd be a good addition to bring in to a lot of the folks that we've been talking to, not just in this environment, but also around all things planning, as you know, we like to do here at the firm. I've known Mike for many years. He's helped several of our clients over the years. He's also been a great resource for our firm in general in terms of just giving us really good ideas to better help our clients. So welcome, Mike.
Thank you. Thank you.
I know we're complaining about heat here in Arizona, but I know down there it's a lot more so than even here in Colorado in the midst of summer, but so we shouldn't complain. But Mike, as you know, the last 3 or 4 months have been there's been a lot going on, to say the least, with COVID-19, with tax changes from the Secure Act. There's been so much going on, and before I dive into some of the details, what I wanted to do was just take a step back. As you know, here at CAM, we're big on advanced planning ideas for our clients, but really maybe just take a few minutes and just in your mind, because I know you guys see a lot of different things, work with a lot of different advisors. Tell me about what are still some of the best ways to utilize insurance strategies for tax planning.
All right. So I think with an ever-changing tax landscape, right? One of the things that insurance does that very few vehicles can do is a couple things. One is the death benefit is tax-free, right? So you can buy a traditional life insurance policy with the intentions of creating a death benefit that goes to a partner, to a charity, to a family member, right? And it's tax-free. So you're avoiding the whole tax consequence on that. What a lot of people don't, I think, understand is when you're in a higher tax bracket, you can use insurance pretty strategically for income tax planning in a sense. And what I mean by that is you can create an insurance shell, and those cash values can grow tax deferred. And then if you structure the policy right and design it, you can actually take distributions out tax free. And there's things you have to follow, and there's some unique things you have to do with the policy, but you're creating a tax deferred vehicle and a tax free distribution vehicle, right, that you can use along with all the vehicles you're using in your world, qualified plans, non-qualified plans, Roth IRAs, various things, to strategically create buckets of money that just have tax efficiency to them. And I think with so much financial burden, chaos out there, tax rates are going to change, right? And whether they're down or up, and a lot of people feel like they're going up just to cover some of the expenses that we've incurred, right? Insurance now has become a much hotter topic of conversation for wealthy individuals to say, let's create that bucket, right? And working with somebody like yourself that is designing a true holistic retirement plan, you can kind of reverse engineer and create strategic buckets of tax efficient monies to use very purposefully and have a very tax diversified balance sheet when it comes time to start pulling income out in the future.
Yeah, and we've talked a lot about that topic, I think, especially in light of, I think, the stimulus and what we're seeing and potentially more in this current environment. And we can't predict the future, but we know that it's got to be paid for somehow. So I think you're right. Some of that tax change, we think, regardless of what happens, even in, let's say in November with elections, it seems likely from what we're hearing from our parties as well. How do you think, kind of, because it is related, how do you think some of those best ways to utilize insurance, not just for tax planning, but even for, let's say, estate planning, how does that factor in right now, what you're seeing with clients?
I think there's obviously there's a lot of uncertainty, right? Because we have the annual exclusion, the credit adjusting potentially in 2025 and a sunset occurring, and we don't know what the exemption is going to be for estate taxes. So I think in my world, what we're kind of having conversations around is, what is my estate value look like, right? And then what are the potential outcomes from legislation? Is it going to hold? Is it going to sunset? Is it going to reduce? And then insurance is just a great, very simple solution to solve that estate liquidity, because you spend cents on the dollar to spend, you spend pennies to get $1 of tax-free death benefit that can be used to cover those estate taxes. So, and it's very flexible. So you can start off with a certain objective and then adjust accordingly. So insurance is a great flexible solution for individuals that do have large estate taxes, where they don't have to start aggressive gifting of ownership of things that they want to control. It's very easy just to go buy a thing, put it out in an irrevocable life insurance, and kind of help solve the problem, whether it's temporarily, permanently, but it's flexible without having to do really long-term gifting that might have recourse, right? So we're having a lot of conversations with the professionals of how do we just prepare for these potential options out here, and how do we do it as least as less as minimum dollars possible, and solve that problem with the most flexibility. Insurance is great for that.
And just kind of curiosity, just ballpark, what percentage of your clients do you see utilize something like what you just said, utilizing those estate strategies, those advanced planning strategies that you work with?
Well, I would say that I think there's a fallacy out there that there's a lot of individuals that think once you get to a certain wealth level, you don't need insurance. I think the reality is usually wealthier people or higher income people are actually buying life insurance more often, but more strategically. It's not just about protecting my spouse and children for income replacement. They're using it as kind of these estate legacy solutions, charitable solutions, just creating a certain level of a balance sheet that they want their heirs to receive. For example, let's say that individual has a $5 million estate, but wants to leave, $2 million to each child, and they have 5 children, right? Insurance is a very simple way to kind of accomplish that goal, right? And it's controllable. So we're having lots of conversations with the individuals you would think really don't need insurance for traditional family protection, but more strategic estate planning or that tax planning we talked about, earlier.
That's great. And I know sometimes a common question we receive, or when we talk about insurance planning with clients or insurance needs, is just not just when somebody might need additional insurance, perhaps, as you know, but also thinking about when should we have even the current policies that we recently obtained or had for a long time. At what point in life should those be reviewed?
That's a great question, Mark, because I think what people don't realize is insurance policies are dynamic, right? There's moving parts within them. It's not a kind of thing that you buy it, put it in the shelf, and you forget about it for the next 30 years. And that's what's happened a lot, because there's assumptions in what's going to happen with the cash value, how it's going to grow, all those kind of things. Our recommendation is at least every 2 years if you have a permanent life insurance policy. And the reason for that is because there's growth assumptions that are assumed within that policy to make it last. And as you all know, interest rates have gone down. So a lot of those assumed performances are much less than what was expected. The expectations it's not there. And there's variable policies that have, mutual funds driving the cash value. Well, obviously that can go up and down, and performance, obviously is continually adjusting. So I would say at least semi-annually, but the other caveat I would add is doing a review the right way, meaning getting in force illustrations that you purposefully are looking for to see about performance versus just whatever the company will send you, right? And that's the easy way out, is they send something to you and you look and say, there's cash value in my policy, everything looks great. You want to get in force illustrations that say, will this policy last to age 100, to age 105, so you can really see how is it performing. In a perfect world, you'd have the as sold illustration or what we expect it to do, and then an in-force illustration, and you're comparing the two. And that's what our platform is about, is we have a benchmark illustration, and then we're always comparing how are we performing to the original expectations. And sometimes you have to adjust. Sometimes you need to add more money. Sometimes you've overpaid. You know, there's ways you can adjust and fix the problem really easily when you catch it.
Mhm. That's great. And that's interesting because you mentioned a couple things in that last question, but also a minute ago as well around interest rates and thinking about things that not just you should do when reviewing a current policy, but utilizing the best strategy. So in today's marketplace, and I think this might play into some of the generational lows we're seeing with interest rates. What type of life insurance strategies across the board are most commonly used in today's market? I know like things like term are obviously used for a lot of people, but there's other advanced strategies out there that exist that a lot of people maybe don't know about or don't know how they work relative to what's available to them today.
Yeah. I think like every industry, there's waves of what is kind of the popular item at the time based off of what's going on at the time. So my industry is very proactive in creating policies that have different chassis in them. And what I mean by that is you have a variable universal life policy that the cash value is driven by a bunch of mutual funds, and you get to create an allocation model within that insurance chassis, and then you get the rewards of whatever that allocation model, how it performs, just like your world, right? Well, a lot of people like that ability, if you have a long time horizon, to get a greater rate of return over time, right? But when something like this happens, you have a correction, all of a sudden people start having anxiety around that. So the natural instinct is we want to go conservative. So on this side of the line, we have products like whole life insurance policies that are very conservative, or universal life policies that are driven more by interest rate environments, right? So what I would say is going on right now is kind of a hybrid. There's a product called an indexed universal life policy that allows you to mirror the S&P 500 performance, but there's a floor and a cap. So it kind of collars what the S&P does. So it kind of, I would say, kind of gives a little bit of a best of both worlds, that you can be in the market and get some upside potential up to a ceiling or a cap. That cap can be anywhere from 9 to 10%, but there's a floor of 0 to 1%. So you can protect any major corrections, but participate in the upsides. So right now we're doing a lot of indexed universal life because people have anxiety about just market and the world in general, but at the same time, interest rates are so low, these more conservative policies over here aren't paying much. So this index universal life seems to be the product of choice right now, just to reduce risk, but also have some upside potential. And when you design this properly with the proper assumptions, right, it can be a very strong kind of consistent rate of return in that 5 to 6% historically, without a lot of volatility to it.
So it sounds like there's some not just different strategies available today as industry has evolved in your world, especially as ours, but specifically to the low rate interest rate environment, which none of us are immune to because we see what our checking accounts aren't paying. We see how cheap it is to refi a mortgage and and whatnot. So that's one of the things that maybe investors should think about beyond just managing risk or covering the risk, but maybe thinking about ways to take advantage of the current environment.
And Mark, you can kind of think of it in your world too, right? Is you can design an insurance portfolio that has pieces of any of those options so that you're matching the risk and the rate of return assumption to the client's risk tolerance, right? And the time horizon objectives, all of that. So there is, in our world, a lot of creativity and options to really create the optimal insurance portfolio that I don't think a lot of people take the time to truly dive into, and the effort to really create the right, potential portfolio there.
No, that's good. That's a good point. And related to, and I know there's a lot of different ideas that your firm applies for strategies for clients. One of the common questions that comes up a lot, and I think it's definitely a bigger topic in general, but just as part of these solutions, not just in general that makes sense for clients in managing risk for retirement income or longevity, but thinking about how the market's changed. What about long-term care? I mean, people have debated that. You hear the same stuff I do, probably a lot more than I do about, does it make sense? If it does, why and how?
So I think that long-term care is risk management, right? And what you're trying to do is transfer risk to a insurance carrier for the possibility of something happening. I think what long-term care brings that is unique is it's actually a very high probability of needing, right? So either you have to build it into your plan, meaning the retirement plan, and use your own funds that you've saved, which is great, or can you transfer that risk to the insurance company? And even though you can self-insure, I believe a lot of times it makes sense to transfer that risk because of the statistical probability of it happening. So a real simple, easy kind of formula that we use is called the 70-70-70, which means 70% of couples that are in their 70s will use some form of long-term care, and the average cost per year nationwide is $70,000 a year. So that's a really high risk and a really high cost. So even if you have $10-20 million liquid there that you live on, why not take some of that money and leverage it? So what we're seeing a lot now in the long-term care space is this ability to take a chunk of money and put it into an insurance shell with a long-term care rider and leverage it. So for example, $100,000 might go in, that might lever up to depending on your age and health and all of that, might lever up to a $400,000 bucket of money that basically if you pass away, your heirs get, or you can use for long-term care. So at the same time, you might be able to keep this $100,000 growing, right? So on your balance sheet, you still have a chunk of money that's growing, just not very fast, but you have leverage in case you pass away prematurely or you have a bout where you need long-term care. So I think it makes a lot of numerical sense to transfer that risk, but more importantly, I think with the products that they've designed, there's a new style now called indemnity style benefits, which means that instead of the old system where you had to save receipts, submit into the insurance company, and then they would reimburse you for those expenses up to your monthly benefit. In an indemnity style, once you qualify, you can use that money however you'd like. So what that means is it changes the whole family dynamic that, as we all know, most of the time when there's a long-term care situation, the family jumps in to take care of that person. Nieces, nephews, grandchildren, children, whatever it is. And usually they do it without charging, without fees. And sometimes that's fine, but other times it's a sacrifice for those family members. So by this indemnity style, it allows the ability to pay those people, right, to drive them around. So even from a numerical standpoint, I think it makes a lot of sense. From an emotional standpoint, now there's kind of this bucket of money there that the family has agreed to. We're using this to take care of care, and it's purposely there to pay the people that are assisting without having to sacrifice other assets. So I think there's two parts to that is making that conversation really prevalent, and I think a really vital part of the planning that you create, Mark, that retirement planning of there's going to be a cost out there. You self-insure or transfer the risk, and then what are the benefits by transferring the risk? And I think by the way it's priced, it makes a lot of sense even for wealthy people.
No, that's great. And I think that the indemnity and what's involved there as well, and probably will continue to evolve, it sounds like, because that is important. And we hear from family members who are working either for their spouse or for a parent perhaps, And not just the financial impact or challenges there, but we also hear about just the emotional, you're right. We talk to financial therapists who share those stories with us as well and what they go through. And so having that plan in place beyond just the numbers and the longevity factor, right, and making the dollars last, there's a lot of other things that I think clients need to be aware of, and you just highlighted a few of them and some of the changes that have happened. So that's great to hear. Shifting gears a little bit, I want to talk a little bit about small business owners and executives. I know we here at our firm, we do a lot of planning for that audience. I know you do too. What are some of just the most common ways that you help small business owners, best utilize some of these insurance solutions you've talked about so far?
With the business owner, there's a lot of areas where there's risk that they're trying to cover. For example, a buy-sell arrangement. If somebody passes away, how is that business going to carry on and buy each other's shares out and all of that, which is usually funded with life insurance because it's efficient and easy. That's one area. The other area is debt that they're associated with the business, with new loans, right? That you can obviously very easily insure that debt and have decreasing death benefits to kind of solve that or match that as well. Where we also spend a lot of time is with successful businesses that are profitable and they're trying to attract, retain key people. There's a whole type of planning called basically non-qualified executive compensation planning, deferred compensation plans, executive bonus plans, salary continuation plans. Those are all kind of very specific plans that are designed to reward, retain executives that you can discriminate to, and there's some kind of commitment that if you stay with me for X number of years, I'm going to give you X amount of dollars or X income for a certain period of time. A lot of that is funded using life insurance products, like we kind of talked about a couple minutes ago with as a holding tank because the tax efficiency tied to it. So a lot of the cash values that are being accumulated for that future commitment to pay to that executive, the company will hold inside of an insurance policy for the tax efficiency that it gives to the company. At the same time, they can have insurance either on that executive for some kind of commitment or to help fund the buy-sell. So a lot of times you can be really creative and tackle multiple risk issues at the same time, create a very specific holding tank, right, of monies that's tax efficient at the same time. So we do a lot of helping business owners just navigate, right, the buy-sell issue, the personal estate planning issue, and then how do you reward those key people in your business, right? And then is there ways to combine all that? And insurance is the greatest vehicle used to fund a lot of those commitments.
Yeah, and we've seen that more and more. And I think there's even an element of that for the exit planning side, which I know is a bigger topic as well. But related to the executives, we're seeing more and more clients come up with the need or come to us with, hey, my company just provided these benefits, right? They just funded these non-qualified plans, like you just mentioned, or they're providing us more executive compensation through the stock. One of the things that we often hear about are these executive benefit plans for high income earners, right? Whether it be a small or mid-sized business, or let's say a really large company. And we often hear or get feedback from some clients initially that say, well, we have plenty of insurance, right, given to us already. At what point does it make sense for some of those highly compensated or high level executives to obtain a separate policy beyond just what the company's given them?
I would say, in my experience, a lot of those executive kind of benefits that involve life insurance are usually very efficient from a cost perspective. And there's been a few cases where they allowed the employee to fund permanent policies with those type of policies that were really efficient. So I would take advantage of that if you can, or at least do an analysis compared to a street product to see if that's efficient. The only thing I can say about owning your own insurance and being in control of it is you are in control of it. right? And there's no limitations, right, by that. Some of these group plans, right, are transferable. Some there's limitations on that. So I would just be cognizant of, if I do a group plan, can it transfer to me very easily without any limitations, which is usually the case, which is great. If there are limitations, I would, unless the company's paying for it, I would always try to do it on your own. So you can control the underwriting, you control the company, you control the design, and you can design it to your specific needs versus having to take what is offered. But if the company's offering some kind of benefit and they're paying for things for you, right? I would suggest looking into that to analyze that. Usually those are good things.
Right. Yeah, that's good feedback, and those are kind of a one by one or one-on-one situations as we come across them. And I know you've given a lot of great information, so I appreciate this, Mike. This has been really great for our audience. One of the things I wanted to dive into just for a couple more minutes is the current world we're in. As I mentioned before, the start of the conversation, the last 3-4 months has been something that no one's, at least in this country, has ever seen before, right? And the impact is so many in different ways. But when it comes to just insurance planning and some of the advanced planning that goes around with that, has COVID-19 changed the need for some of those life insurance strategies?
I wouldn't, I think the need's there for whatever the objective is. I think what has changed is there's obviously been a deeper kind of thought around on your personal mortality, right? Because we all know somebody that has it sick that is, could potentially pass away from COVID. So I think it sparked the desire to think about life insurance more strategically. What has happened in this world is the insurance companies have, there was a knee-jerk reaction initially when we didn't have a lot of information that they didn't know how it would affect mortality or pricing, right? So the knee-jerk reaction was anybody over the age of 71, we won't underwrite. So literally that whole 70 to 85-year-old population could not get insurance for a couple months because of COVID. It's kind of snapped back to the carrier saying, okay, we'll go up to age 85, 81, whatever the different carrier says, as long as they're a standard rating. And I think what's come from this is you're not really passing away from COVID. You're passing away because COVID, right? You have some kind of comorbidity factor that's causing your body get inflamed, and then what happens from that. So what they're really trying to do is price or figure out, do we need to deal with diabetes differently because COVID is out there, right? We knew how to price diabetes from the traditional sense, but now we have this new threat to diabetics. Are we pricing this into the policy correctly? There isn't enough data to do that yet. So I think carriers are kind of, they've all cut back saying, if you're not in that standard category and above 70, there's a lot of limitations. So now I think we'll get through this, the pricing will get figured out, and they'll get back to normal. But it has been a very interesting time, and I would suggest, if there is the desire to get insurance, knowing what the lay of the land is now and knowing your health and how it relates to that, I would kind of initiate that. And if I can add a little here, that when you're going through the underwriting process, right, you're sending your medical information to an underwriter that's looking at that without knowing you, right? And they're looking at these line items, and they have to make a decision on you. And obviously underwriters have good days, bad days. They have different, carriers have different personalities. So always use a system where you're shopping this out to multiple carriers, so you're getting multiple feedback, because that's the way we do it. And we'll get completely different offers back from 2 different carriers, right, that have very similar guidelines, but one will come back preferred, one will come back standard J-Bolt B, right, looking at the exact same information. So make sure you're maximizing that underwriting efficiency with the right firm to make things, kind of for the best outcome for yourself.
Right. In addition to some of the changes you just mentioned that the industry's modifying in the underwriting process, perhaps, do you anticipate any other changes moving forward with anything else that you've seen recently?
There's a couple of the good things are our industry is a little bit archaic, a little bit of a dinosaur. So because people were so sensitive about doing exams and having that face-to-face contact, that these insurance carriers kind of sped up the process of creating their online application systems, their DocuSign systems. So now there's multiple companies, if you're under certain death benefits and certain health categories and ages, that you can do things through a portal, and if you're healthy, not have to do the exam. So there's been some efficiency, I think, or client-centric systems have been put in place because of COVID that I think are going to carry through. And now that they have the foundation set, I think the technology will continue to be more efficient for all parties. But I think the consumer-driven fear caused them to react very quickly to create some of these things that we've needed for 10 years. So,
yeah. No, I think it's interesting that not just in your industry, but a lot of industries, ours industry is also in that world, and a lot of other industries. But what's happened the last 3-4 months is forced everyone to push forward some timelines that were maybe on the radar, but made us do it a little faster by several years, perhaps. So that's great. Just the last question I have for you, Mike, is I like to end, or I'm a half glass full kind of guy. I know we're going through a lot of things right now, but what opportunities do you see that even after everything we've been through, what do you see clients, your clients, our clients, our audience should be thinking about and really looking for opportunities to take advantage of in today's world? So I think they exist.
And I'm going to come at it from my industry.
Sure.
Our industry has been around longer than the 401k and mutual funds and all of that. So there's a lot of history and leverage and lobbying that I think our tax efficiency of the internal the workings of our policy are going to stay. So with that, I think there is great opportunity with what I think the future is going to hold, which is potentially increased taxes, more liability exposure. And we didn't mention this, but a lot of states have creditor protection for the cash values that are inside life insurance. So because of that, I think there's a lot of opportunity to use insurance shells as very good tax planning vehicles, creditor protected vehicles, and I think that that's going to be a safe place to go because the size of the insurance industry, the strength of the insurance industry, the longevity of the insurance industry, right? They're some of the oldest companies and strongest companies there are, right? So I think that's going to be a vehicle to purposefully look at, to put on your balance sheet and be more strategic with, right? And there's going to be a lot of creativity that's going to come in your world of how to use those things and optimize the balance sheet. And I think insurance is going to be one of those things that's going to be a great vehicle or thing to use to do that.
Fantastic. No, that's great. I think those are the things that, again, I like to hear ideas from someone like yourself, because it doesn't just help us become better advisors to help our clients, but it sparks thought and keeps people aware of a lot of the things that they just may not have any idea, either because they haven't had to deal with some of these more advanced planning topics, or they're just not there yet in their lives, but it's good to know about. So Mike Olson of WealthPoint, I appreciate all the time as always. It's always great to catch up and just and see you in this environment. I look forward to having you back again in a few months. We'll see what the world looks like and what other opportunities exist, and we'll just stay in touch and go from there.
That would be great. I look forward to it.
Thanks a lot, Mike.